Okay, what I'm going to demonstrate here is how to amortize the discount on a notes payable, and a notes payable would have annuity payments, and we'll use the effective interest method. So what is our notes payable here? Say for example we purchase services in exchange for notes payable here in the beginning of year one, and then at the end of the next 4 years we pay for those services here. So for example, we'd pay $1,000 at the end of each year for those services that we purchased. So what we have to do here is determine how much interest expense is included in the notes payable. And once we know that, then we'd amortize or allocate that interest expense paid on the notes payable to the income statement over the next 4 years. So let's go and see how we do that. Now, the cash to be paid by the time it would be at the end of every year for 4 years, well, that would be a total of $4,000. Okay, then we have to discount back that cash paid each year, and we do that by either using a calculator, or in this case I used an Excel formula. So here I took the Excel formula, the present value, and I put in the rate here of 10%. That's what I figured was on the notes payable, and then the number of period here would be 4 years, and then we made a payment each year here. That would be an annuity payment, $1,000, and then those payments here were received at the end of the period, so I put in a 0. So after calculating the annuity present value here of those payments, it was $3,170. So now we can determine how much interest expense we paid. So we know we're getting $4,000 minus the $3,170 present value of those four payments of $1,000 each equals $830. All right, let's determine our interest expense for each year on the notes payable. Let's go through it step by step here. We start with our beginning balance. Now, our beginning balance was the discounted notes payable value at the time of the transaction, and that was its present value. So we determined that to be $3,170. Next, we take our interest rate, which was 10% times the beginning balance for the year, and 10% times 3,170 is $317 in interest expense. Then we subtract out the interest payment we made at the end of the year, and we have an ending balance of $2,487, this represents our carrying value of the notes payable. Then for year 2, we take the ending balance of year 1, and that's our beginning balance of year 2. We go through the same steps. 10% times the beginning balance here, $2,487, equals $249, less the payment that we made of $1,000, and we get $1,736, our ending balance. So then years 3 and years 4, we followed the same steps. All right. Then our interest expense that we are going to use amortize or discount on the notes receivable expense is calculated here as we use the first year beginning balance times the interest rate. Okay, and then remember our first year balance equals the end of last year's balance. So the first of year 2 balance, $2,487, would be the ending balance of year 1, $2,487. All right. Let's look at how we'd record notes payable. Well, notes payable is a liability on the balance sheet, and then we have a discount on that notes payable, which is a contra expense account, and then we have our notes payable expense here, which is part of net income on the income statement. Okay, so if we start in year 1 when the services were purchased, we exchanged the notes payable, so we increased our notes payable by $4,000. And then we have a discount on those notes payable. Now remember, this is a contra expense account, so it reduces notes payable. So we started out here with a debit amount of $830, and that would be in year 1 when the services were purchased. So that's our $4,000 worth of payments they're going to make minus the present value of those payments, which was $3,170, which equals $830. So each year we reduce the discount on the note payable here by the amount of interest expense we paid. So we record our interest expense here as a credit to discounts on notes payable, and then the associated debit entry would be an increase here in our service expense for those interest payments we make each year. So if we look here, year one when the services were purchased, we increased our service expense for the present value of those services, which is $3,170. Then we added our interest expense in each year, and then our total amount here was $4,000 for the service expense over that years 1 through year 4. Now let's go back here and look at our notes payable on our payments. So at the end of each year we made a payment of $1,000. So at the end of the 4-year period, our notes payable here would be reduced to the $4,000 credit amount minus the $4,000 debit amount. You got 0 here in notes payable, and then each year our notes payable, we reduced our cash by the amount of those payments here of $1,000 per year. So this is just an overview of how we would record a notes payable with a discount here.